Welcome to Tech Talk Tuesday. We are recording on a Monday so that you can listen in on a Tuesday. It's Monday, November 27, 2023. My name is Carla, and with me today is your favorite CMT, David Blake. David, how are you doing this morning?
Well, Carla, thanks.
Great. Well, let's jump right into it by taking a look at last week's stock market activity and what's ahead.
Okay. Well, the Bulls were back in control last week for a fourth consecutive week now that the major averages extended their weekly win streak. And that's actually the longest win streak that they've had in 7 months, which would go back to, I guess, June, July, well, actually before that. I guess it was April or something like that when they had that many weeks in a row up. So anyway, we started out on Monday. Came in, investors were in a festive mood. It was a short week, but they bid stocks up pretty rapidly. They almost 500 points, I think, early in the day on the Dow Jones. They were kind of getting excited before NVIDIA came out with their earnings on Wednesday, or maybe that was on Tuesday, I guess. But anyway, so they paused on Tuesday as far as the buying went, as they kind of waited for NVIDIA to report after the market closed. But also, we got the FOMC meeting minutes in the afternoon. That kind of showed that maybe the Federal Reserve wasn't quite ready to declare victory over inflation. They keep reiterating we're going to keep these rates higher for longer because we got work to do, and just a few data points aren't going to be enough to make us start thinking about cutting rates yet. So that kind of the market was a little bit kind of flat on that type of thing. And then we started getting some earnings on Wednesday from some of the retailers, and they were strong. In fact, let's see, we had a couple of them. Trying to see what we had here that beat. Well, they all beat just about. But Lowe's, Kohl's, and Best Buy, despite beating on top and bottom line, they issued kind of a little bit weaker guidance than what was expected, which again had started to pull back a little bit with the markets. Then we got NVIDIA's earnings, and that was kind of a sell the news. But yeah, you kind of had to expect that. The stock had run up so much going into the earnings that they blew away even the most optimistic earnings reports out there. And but again, just when you have a stock that runs like that up into the earnings, a lot of times you have rapid traders quickly pull some money out of that. So I came back, and since then NVIDIA's starting to work its way up a little bit higher, which is still looks good in the long-term charts and all. We did have a little bit of a tick higher in yields on the short Friday session that we had. That kind of it just showed that the jobless claims and that type of thing showed the economy is still resilient. The rate on the 10-year closed the week at 4.47. That's important to note because as we've mentioned before, on the way up with the rates, once they crossed above that 450, 455, we saw stocks struggle. So we're getting up to that level now. I think you still need to keep an eye on that. I would say if we get up around 455 to 460, somewhere around there, 462, that you could see stocks struggle again. That's that 447 is after trading as low as 436 on Wednesday. Okay, we had a weaker U.S. dollar, which helps stocks. As the dollar gets weak, it's better for for equities and especially internationals. And then we had we had crude oil also was down, which kind of weighed on stocks again. That seems to be having trouble getting out of its way. Part of that is because OPEC plus delayed a meeting that they're supposed to have over the weekend about keeping production limits on things. But we're still getting oil from the United States, of course. But Venezuela, Iran's sneaking some on there, and some other sources are bringing oil onto the market. So just the fact that OPEC threatens that they're going to slow down production, it's not having much of an effect on oil at this rate because the other sources are starting to pick it up. As far as the market sectors go, every one of them was higher during the week, and that's for the second week in a row. We talk about the market to rally starting to broaden out. That's one measure that you can look at. And the fact very rarely do you have 2 weeks in a row where you have every sector higher. So that's something that you want to take notice of. And so when we got all done, it was another positive week. We've almost erased the whole August October sell off, and as of Friday, the S&P 500 is on track for its best month since July of 2022. As far as the technical condition of the market goes, it did improve a little bit, but over that 4 week period, we've gone from an oversold condition in October to an overbought condition now in the 4 weeks. We had stochastics that are up in the mid 90s on all just about every index. And then I went to the 9-day RSI. Generally, we look at the 14-day, but the 9-day also is one you look at for the overbought, oversold. And it ended the week in the mid 70s, which is the most overbought that we've had the market since the July peak. In addition to that, we have the S&P short range oscillator, which is you can only get through MarketEdge. That's probably one of the most reliable overbought, oversold indicators, and it closed Friday at 7.27%, which I think maybe the last time it hit that was back in July. Probably, I'd have to take a look, but when it gets above 5%, I think it is, or above 4 to 5% is over a little bit overbought. By the time it gets to a 7%, historically that's led to some profit taking or consolidation in the different indexes, and we're kind of seeing that today in the market. You have the Dow down, the transport's down, the Russell's down, but the Nasdaq's up a little bit. That's basically because we had a little bit of a pullback in yields today, and of course the big Magnificent Seven, when yields start to come down a little bit, those stocks always go up, which they're doing today. So we have that going, but I would look with this SRO, especially up here at the 7 level, for the market to consolidate some of the gains from the last 4 weeks. So that just kind of means, doesn't really necessarily mean you go out and sell stuff. It does mean that you probably will see the market go sideways to maybe have a little bit of a short-term dip. We'll have to watch that. Now, one of the things I noticed, a lot of times as a technician, we will look at weekly charts. A lot of times when stock indexes are making short-term highs, that type of thing, you'll start to see negative divergence in the RSI indicator, maybe some in MACD, that type of thing, where you don't have as much momentum. It's making a new higher. It's making a new high, but the momentum is slower. Think of it kind of if you have a baseball and you throw the ball up to the ceiling. The ball's going up, but the velocity of the ball going up is slowing as it gets near the top. That when you see that and compare that to an RSI indicator, it's kind of what we mean. That's negative divergence. In other words, it doesn't have the same oomph behind it as it did here about 2 weeks ago. So that's something we're kind of watching. It's but like I said, we did not really see any signs that the negative divergence is really coming in. It's slowing down a little bit, but not much. And on the weekly charts was where I was trying to go with this. I didn't see any of that at all, which is normally where we'll see a lot of that. And in fact, the MACD, which is kind of a short-term trend gauge that we look at, actually was giving a buy signal on all the different indexes. That's something you want to look at. So that's telling you that going out another week or 2 or 3, we're probably still going to see the bulls in control here. Of course, a lot can happen between now and then, but that's what we're looking at right now. The secondary indexes, which includes the Dow Jones Transportation Index, the small cap Russell 2000, and even the Philadelphia Semiconductor, their charts remain bullish. But we did see the Russell 2000 run into its 200-day moving average last week. That's something to kind of keep an eye on. You'd like to see these indexes kind of lead the way, and they're bullish, but they're not outperforming the broader indexes here the last week or so. So that's something to go. Although last week, one thing to bring up is that the semiconductors, if you just look at that, it was flat for the week. However, off the October low, it's up 21%. So that's quite a move. You have to expect the semiconductors to kind of consolidate in here, maybe drift a little bit up and down a little bit, just to try get those prices right. They can't, they don't go to the moon. So just kind of keep an eye on that. If you see your Nvidias and AMDs and Broadcom and stuff pull back a little bit, at this stage, you might consider that they might be, maybe if you love them, you might want to add to the position. But after 21% move in that index, I'd be hesitant to try to add to positions at this time. So anyway, we have noted last week the market rally has broadened out. Every sector positive for a second week in a row, and but that's bullish for just the market in general, because all summer long we kept talking about, we did see negative divergences going up as we were going in through June, and that meant that even though the market was making new highs all up into the end of July, it was led by a narrow group of stocks, which usually is a red flag, and as we found out in at the end of July, that was a problem for the market, and the market pulled back. As far as underlying breadth goes, it's still fine. We had the NYSE and Nasdaq advanced decline lines going higher. We also saw new 52-week highs outnumber the new lows on the NYSE. I said in a letter, the NYSE and the Nasdaq for the first time since early August. The Nasdaq, by the time I got around Saturday to check it, actually did have a few more new lows than the new highs, but still is one of the tightest it's been since the end of August. As far as sentiment goes, we're getting a little bit frothy with the bulls. Everybody's singing about the end of year rally that we're kind of in the process of having, and as far as the retail clients go, the bulls outnumber the bears now about 2-1. That's the biggest disparity we've had since the end of July. And when they get to these, you kind of, where these numbers are so eradicated like this, you'll find that they're kind of contrarian indicators. It just means that when everybody's too bullish, who's left to keep buying stocks? That usually means if you're too overly bullish, you're already in everything, and you don't have any money left to put into the market. And we also saw on the professionals, the National Association of Active Investment Managers Exposure Index is now at 77.9%. That's up from 24.8% just 4 weeks ago. So they got in at the right time at the end of towards the end of October, and they've been adding to positions. That's gone up for 4 weeks in a row. Just to wrap it up on that, last week I did say that we're probably due for some consolidation this week. After 4 weeks of gains, everything's bullish. However, you got the bull needs to rest every once in a while, and there's always something that can rattle the market. This week coming up, we have kind of a busy week. On Thursday, it's just a couple economic events coming up, but on Thursday we get the Fed's preferred inflation gauge. That's the PCE, personal expenditure index, which will kind of just shows what people are spending and saving, that type of thing. And when we look at the core PCE, we'll get that on Thursday, and that's probably I would say if we get it if it comes in as expected, maybe even a little bit lighter, that should probably trigger the bulls to keep in control and the rally to go a little bit longer. If we happen to see inflation spike up a little bit from something, which I don't think we're going to, mainly because oil's come down, so people aren't spending as much money on gas and that type of thing. I don't really expect any upside surprises, but if we would see that, that would probably that could rattle investors and the market a little bit, and kind of maybe flatten things out for a little bit. And then on Friday we have Chairman Powell speaking again on the economy in front of an audience, and we'll see if he has anything else to add, any new tidbits from his last engagement at the end of the FOMC meeting. So that's pretty much all we have right now. Like I say, if you have any questions, Carla, I think we're right at this stage. Things look sideways over the near term, but the charts still look bullish.
Okay, yeah, that's definitely a lot of things to look ahead to, and a good recap of what we saw last week. I did have a couple of questions though on a few things that you mentioned, David. You mentioned that there was indeed a broad-based rally the last 2 weeks now, actually. Which sectors actually led the way?
Okay, last week, let's see, last week what we had, like I said, and when I said they were all up for second week in a row, that's big to me because that means that people are in there buying everything. And last week the leaders were healthcare, consumer staples, communication services, and materials. So it wasn't all the communication services. That's Meta, and there were a couple other ones in there. Google and that kind of thing that had pretty good weeks. But so we're getting a little bit. It's not just tech and communication services. We're having a little bit of mixture with that. So that's something that we want to see. And also, probably more important than that, maybe not, but anyway, something that I looked at as we looked at the chart last week. That was the fact that for the first time in a long, long time, we actually have the equal weight S&P 500 is outperforming the NASDAQ 100. And that's pretty big. I mean, because, when we talk about, okay, it's the Magnificent Seven, they keep, pulling stocks up and everybody keeps talking about that. But underneath that, even though they're still, inching higher, but just the fact that from here out, are going on right now, the equal weight, which means, the Microsoft and Google and Meta, they don't have an Apple. They're not considered as more of a weight on the index than say something like Freeport McMoran or something like that. Yeah, if you want to go to the chart, let's take a look at that again. Okay, here's the RSP versus the QQQ. Let's go back to, let's say, maybe 1 month on this chart.
All right.
Okay, and here you can see since the end of October there, the equal weight has outperformed. Well, let's see. It actually, it doesn't really show it on this. Actually, it's about the last 10 days. If you hit the 10-day anyway. Okay, there you go. Now we've just started to, outperform the QQQ 100. And that's important because now you're going to start seeing maybe some of the financials, some of the healthcare stocks, some of the industrials, those type of sectors come in and show some leadership, which is important because you want to have them rounded out. That way, if things start to slow down or we get a bump in the road, you're not going to have just those 7 stocks. If they crumple a little bit, then bring down the whole market. Just like we had in as rates started going up in the summertime, that's not good for the big growth stocks like that, and that's when they started to pull back. And because we had such leadership from those 7 stocks, that's why we had such a pullback in the over a 20% pullback about 12% pullback from that July highs. And it was mainly because it was the big Magnificent Seven stocks coming back because of the rising rates. They're not going to go up as rates rise for over the short term.
Okay. Also, another thing that you mentioned earlier is the MarketEdge short range oscillator tool, which is used frequently by industry professionals and happens to be one of my favorite tools that we offer as well. You can find that on the homepage. And you mentioned that it is definitely overbought, over 7% here. I know that Jim Cramer actually had some comments about it this week as well. Can you touch base on that a little bit?
Yeah, the SRO, or the short S&P short range oscillator, has been around since I believe the 70s, something like that. And MarketEdge is the only place really you can get it now. Although Jim Cramer's investment club offers it out to their subscribers also. If you remember there, you'll see him touting that for sure. But what it does is the short range oscillator looks at momentum of the stocks. It looks at the advanced decline lines. It looks at different moving averages. Some of the 5-day back to the 50-day, that type of thing. And what it does, it kind of weighs all these things, and as we start to move up, if things get too good, this thing, once it gets above 5, it's considered 5%. Considered overbought. And once we get to above 7, which we did on Friday, that's just like I said earlier. That's generally a time where you've taken the market's pulse, and it's telling you that, hey, we're tired. You can expect to see some short-term traders will take some profits at that term, wait to go back in a little bit later. Other ones just know that we're probably going to consolidate gains and that type of thing. I know that just from last week, I think it was Kramer was talking about how his club members they now get an exclusive discount to that helpful tool, and he comes right to us and wants us. He talks about the oscillator all the time. He's excited about it. He says it's one of his favorite oscillators. It's like I said, it's one of the most reliable, overbought, oversold indicators out there. Now, one thing to note, it was kind of funny, during the summer, a lot of the SRO, people are saying, boy, the market keeps going up. We're getting ready to make new highs here in the summer. And this thing is only a 3.5 or maybe a 3.75. Now it's a 2.5. And the reason for that was the negative divergence that was going on underneath that rise in the market, where we were seeing a lot of days, the market, the S&P, or I mean, not the S&P, but the NASDAQ would be up, 70, 80 points. And then the oscillator might be flat to maybe down a little bit. And the reason was because it was such a narrow rally that the advanced decline lines were negative. New highs, new lows were probably negative, and you might have like the transports, the Russell actually being down on the day when the S&P and NASDAQ were up just a little bit. And when you have stuff like that, then you can, that's just a sign that you would know that this is a little bit strange, this rally, because the market's not really getting overbought as a whole. Then we found out later on that it was just because those big stocks had run so much that they were. It was just a narrow rally that the overall market wasn't really getting overbought. But now that we're seeing this broadening out, the fact that we all of a sudden now we're up in the sevens just shows you again what we're seeing, that all the sectors are performing, everything's going up, and that's what you want to see as you're building the base for this market to move higher later on.
Okay, that is very interesting to note. And although we are running out of time here, David, really quick, the $1 million question that everyone wants to know: how are we looking for the end of year rally?
Well, rather than me just guess, I would say, we number one, we need to consolidate some of this 4 weeks of rally. This week, historically, the last week of November is generally has a positive bias, but I think that if Thursday morning, get on there, look at CNBC. Let's take a look to see what the PC is going to be. I don't expect to see any upside surprises that would hammer rates and knock rates up or hammer the stocks. But if we would, then the end of the year rally has already happened, and we could see stocks struggle a little bit from there, or maybe just again consolidate a little bit. So rather than guess. Yeah, take a look at wait till Thursday morning, and again, if we get the expected numbers, or even if we see the numbers coming a little bit lower, showing that inflation again is getting weaker, then we could probably move a little bit higher after we consolidate some of the recent gains.
All right. Well, we are now running out of time, but that was a lot of really great information, David. Thank you again for another wonderful Tech Talk Tuesday, and you can catch us again next week.